So joining me now is Dan Geltrude, managing partner at Geltrude and Company, a financial consulting firm. Dan, it's good to see you ahead of a very big day tomorrow. What are you expecting from the Fed?
I think we're going to see at least 75 basis points. I think there's an outside chance it could go to 100, but I think everybody's anticipating 75 basis points. This should come as no surprise. The Fed has made it very clear that they plan on attacking the inflation problem by continuing to raise interest rates until inflation is under control. And what we mean by under control is inflation starts to retract. Even though inflation may be leveling off a little bit right now, we still are in a terrible place when it comes to the price of goods and services right now. People simply can't afford the prices, and the Fed is going to try to kill off demand to bring things in check here.
So how high could we see rates rise? I think that's sort of the uneasy factor, right? I mean, these interest rate rises, they haven't worked. Turns out inflation, which was transitory a year ago per the statement, not so transitory and sticking around at very steep increases, I think for a lot longer, obviously, than many economists had expected.
Well, here's the truth of the matter, and I'm not so sure why the Fed or the administration is not getting the memo here. This inflationary situation that we're in is supply-driven. And because it's supply-driven, the Fed doesn't really have the tools to address that. So what they're addressing is the demand side. Now, as we're trying to bring down demand to put supply and demand in balance, well, it's not working. Why? Because demand is still staying high, and yet we have so many problems in the supply chain, not just in the United States, but globally. We see interest rates going up around the world. So everybody is choosing to fight this problem in the same way, which is on the demand side. In my judgment, that's the wrong side of the equation, and we have to look at policy changes which will address the supply side. To me, that is the best way for us to fight inflation right now.
So what does this mean for consumers, Dan? We talk about the stock market. Not everyone has their money in the stock market. A lot of people are simply just trying to get by, and higher prices are a big issue that they're dealing with, as well as in some cases higher credit card rates, right? More expensive debt. What would you recommend to consumers as a way to prepare for this rate rise that we'll get tomorrow?
Well, the first thing is, if you have credit card debt or any other high interest rate debt or variable rate debt, you want to take a really hard look at that and figure out, is there a way for me to pay that down as quickly as possible? Because that type of debt is going to get very, very expensive. Now, for the investors out there, listen, as interest rates continue to rise, I think we're going to see equities continue to suffer. So for those investors out there that are a little squeamish about the market, you know, there's some real opportunities for some stocks that have come down to probably some very reasonable pricing. And then the other thing to take a look at is we're going to see the interest rates on savings accounts and other safer investments going up. So people should look at, you know, where they want to diversify their portfolios, where they can get probably a pretty nice fixed rate of return because of where the interest rates are going right now. So there's good and there's bad.
Yeah.